Paying off your mortgage faster won't make you rich. Growth rates don't build wealth. Exposure does, and structure multiplies it. Let me show you what I mean. Mac here, I uncover property so you don't have to uncover it the hard way. Today we're using real Brisbane addresses, real sales, real growth rates, real rental figures, real holding costs, because opinions don't build wealth, exposure does. Here's the wealth illusion. People see New Farm, prestige, blue chip, premium suburb. They see a $3 million home and think, that's serious wealth. Then they see Slacks Creek and think, risky, low socioeconomic, not for me. But smart investors don't buy suburbs. They buy exposure. Income is just a tool. Assets produce wealth. Leverage magnifies exposure. And exposure determines the dollar outcome. Not ego, not postcode, not emotion. So let's get specific. There are real Brisbane properties. These are real sale prices, real rental estimates. And we've run some rough modelling using the historical growth rates and reasonable assumptions around rates, rent growth and costs. This isn't financial advice, it's a scenario modelling to illustrate how exposure works. Now look at this. 16 Lechmere Street in New Farm just sold for $3.043 million. Just a very average looking home. Estimated rent, $1,100 per week. The 10-year house growth in New Farm for the median values is 98.7%. Then we've got 2 of 71 Park Road, Slacks Creek, sold for $601,000, estimated rental $490 per week. The 10-year unit growth rate for the median price in Slacks Creek is 176% over 10 years. Now let's model another 10 years. Assumptions: 100% loan, 6.5% principal and interest, 4% rent growth annually, and 7% rental management cost, $3,000 in maintenance per annum, and 3.3% selling costs. Okay, New Farm in 10 years. Future value, $6.04 million. Net sale proceeds after loan, $3.28 million. Annual holding cost, $172,000. Total net possession after 10 years, $1.56 million gain. Massive exposure. Massive holding pressure. One asset, one postcode. Now let's look at Slacks Creek. Future value, $1.66 million. Net sale proceeds, $1.1 million. Annual holding costs, $20,500. Total net position, $891,000 gain. Lower exposure, lower holding costs. Still a strong outcome. Now here's where it gets interesting. Instead of one $3 million New Farm property, what if you own 2 Slacks Creeks properties at $601,000? So a combined exposure of $1.2 million. Here's the result. Future value combined, $3.31 million. Net sale proceeds, $2.19 million. Annual holding costs, only $38,000. Total net position, $1.81 million gain. 2 mid-market properties, higher total net gain than New Farm. Less than a quarter of the annual holding costs, diversified risk, and greater scalability. That's not percentage, that's exposure multiplied by structure. Exposure beats percentage, but structure decides whether exposure works. Now let's address something uncomfortable. Many Australians are aggressively paying down their home loan, reducing debt, reducing exposure, reducing growth participation. There's nothing wrong with being debt-free, but understand the trade-off. Paying down debt improves security. Increasing exposure improves wealth production. Different objectives. If your only goal is safety, pay it down. If your goal is financial freedom, you need exposure. And exposure requires strategy. A few years ago, my wife and I had a decision: use equity to buy an investment property or upgrade our home. We chose to upgrade. Bigger house, better location, higher loan amount. Why? Because increasing exposure in a premium location aligned with our goals at that stage. similar growth percentage, higher dollar outcome, no capital gains tax, no tenant management, but also no diversification. That was a conscious strategic choice, and that's the key. Exposure must align with your goals, not someone else's. Wealth isn't about chasing the highest percentage, chasing the flashiest suburb, paying debt down as fast as possible. Wealth is about understanding your borrowing capacity, using income as a tool, structuring exposure wisely, and holding through cycles. Income doesn't build wealth, it enables exposure. And exposure, structured correctly, builds wealth. Before you do anything, find out your capacity. It doesn't cost you anything to know what's possible. It simply gives you options, and you decide what to do with those options. Exposure without strategy is risk. Strategy without action is wasted potential. Don't leave it to hopes and dreams. Make it a reality.